My topic is volume pricing and detail explain, and let's go to the topic and let's go to the start. Volume pricing is a strategy used by businesses to offer customers discounts for purchasing larger quantities of goods or services. Generally, the more units a customer buys, the lower the price per unit. This type of pricing strategy motivates customers to buy more to enjoy the discounts and often results in increased sales and revenue for businesses. Volume pricing can be applied to various industries, including consumer goods, software, and business services. It is also commonly used in business-to-business transactions. Volume pricing, also known as volume discounting, is a strategy for pricing products or services that provides price reductions for larger quantities. The price per unit decreases as the quantity of the overall purchase increases. On the supply side, volume pricing allows for faster sales of inventory and increased sales numbers. For the customer, it rewards those who make large volume orders and encourages them to purchase more per order to take advantage of the reduced cost. Volume discount pricing means providing discounted prices for bulk purchases. It's a pricing model that product manufacturers and service providers use to encourage individuals or businesses to purchase multiple units or large quantities of a single product. It's a win-win strategy for the seller and the buyer. The seller can reduce their inventory, while the buyer takes the opportunity of quantity discounts to optimize their cost. Volume pricing strategy relies on the fact that everyone loves a discount. With a volume discount, you create the perfect incentive to encourage customers, individual or business, to buy goods in bulk or in larger quantities. By rewarding those that buy more with a reduced price per unit of your product or service, you're more likely to profit from a higher sale. If customers see greater value in bulk purchases or buying large quantities, it can be hard to resist. Tiered pricing and volume pricing are a bit more complex than standard pricing because the more someone buys, the more the price changes. There's also an added layer of confusion around the terms because they're often used interchangeably. In reality, there's a difference between the two types of pricing. One may maximize revenue while the other may maximize your ability to acquire new customers. In either case, it's important to fully understand what each pricing model entails so you can make an informed decision. Tiered pricing is when you define the price per unit within a specific range. When the number of units exceeds that range, subsequent products have a different price per unit. With the volume pricing strategy, the prices of items are lowered when customers buy more of them. Best for companies looking to price based on individual items, licenses, users, transactions, rather than features. Volume pricing works well for businesses that typically receive, and want to encourage, large orders. Example: a design platform charges $99 per license when customers buy fewer than 20 licenses. However, the price of each license is lower if customers buy more of them. Easy for customers to understand when they'll benefit from the program. Competitive differentiation incentivizes use of and reliance on the offering. Volume discounting is a pricing method where a business incentivizes customers to a higher volume of a good by offering discounted prices for higher quantities. For instance, a company that sells t-shirts wholesale might charge full price for 100 shirts but half price for any more shirts purchased after that. Volume pricing, also known as quantity pricing or bulk pricing, refers to a pricing strategy in which the price of a product or service is determined based on the quantity or volume purchased. It is commonly used by businesses to encourage customers to buy larger quantities of a product or service, which can lead to cost savings and increased revenue for the seller. In volume pricing, as the customer increases the quantity of items purchased, the price per unit typically decreases. This approach benefits both the seller and the buyer. The seller benefits from increased sales volume and potentially higher profit margins due to economies of scale, while the buyer benefits from a lower average cost per unit. Volume pricing is often employed in various industries, including manufacturing, wholesale distribution, retail, and services. It can be applied to both physical products and digital goods, as well as to services such as software subscriptions or data plans. For example, a supplier may offer tiered pricing for a product where the unit price decreases as the customer purchases larger quantities. The pricing tiers might be structured as follows: 1 to 99 units, $10 per unit; 100 to 499 units, $9 per unit; 500 plus units, $8 per unit. In this scenario, A customer purchasing 50 units would pay $10 per unit, resulting in a total cost of $500. However, if the customer purchases 200 units, the price per unit decreases to $9, resulting in a total cost of $1,800. Volume pricing can be an effective strategy to incentivize customers to buy more, increase customer loyalty, and strengthen relationships with business clients. It encourages larger purchases, reduces the average cost per unit for the buyer, and can drive higher sales volumes for the seller. Threshold volume discounting. Threshold volume discounting is a method where the discount a business offers only goes into effect after a buyer hits a certain threshold, or quantity, with their purchase. For instance, a supplier might offer a discount on any units purchased beyond an initial 100. Tiered volume discounting. Tiered volume discounting is similar to the threshold method in that buyers are offered discounted prices after purchasing a certain quantity of a good. But while threshold volume discounts apply broadly to every purchase after a certain point, tiered volume discounts are offered in levels, meaning 100 units might come at full price, the next 50 might come at 75%, and the 50 after that might come at 50%. Package volume discounting. With a package discount, a company offers a discount for a predefined quantity of a product. For instance, it might offer a discount on packages of 100 units. If a firm buys 99 units, it doesn't get the discount. If it buys 101 units, it only gets a discount on the initial 100. Volume pricing is a pricing strategy where the price of a product or service decreases as the quantity purchased increases. This strategy is commonly used by businesses to incentivize customers to buy more and to reward larger orders. For example, a business may offer a product for $10 each, but if a customer buys 10 or more, the price drops to $8 each. The idea is that the more a customer buys, the more they save per unit, which encourages them to purchase more. Volume pricing is often used in industries such as manufacturing, wholesale, and retail, where customers may be buying large quantities of goods. It can also be used in services industries, such as software licensing, where a company may offer lower prices to customers who purchase a larger number of licenses. Overall, volume pricing can be an effective way to drive sales and encourage customers to make larger purchases, but it's important for businesses to carefully consider their pricing strategy and ensure that it aligns with their overall goals and objectives. It can encourage buyers to purchase more. This point might seem kind of obvious, as it's the literal endgame of the strategy itself. Volume discounting, like virtually any other kind of discounting method, is designed to incentivize buyers to purchase more. If you can construct an effective volume discounting pricing strategy, you should be able to consistently drive higher volume purchases. You undermine potential profit. This point is relevant to any discounting strategy. By offering goods at lower than normal prices, you're cutting into the profit each unit generates. But if you sell enough at a discount that's not too drastic, you can offset those per unit losses with higher sales. Like any other promotion, it can attract new customers. Discounting, as a concept, rests on the fact that a lot of buyers are receptive to better deals, and if you can effectively tailor and promote a volume discounting strategy that will pique buyers' interest, you can attract a solid base of new customers. It can set unreasonably low pricing expectations. This is a risk you always run with offering any kind of discount. Any of these methods can essentially move the goalposts and become the standard of what consumers expect from your brand if you're not careful, and a volume discounting strategy is no exception. In simple terms, volume pricing is a pricing structure that figures in discounts for large quantity purchases. The more that is purchased at one time, the larger the discount. This blog has previously touched on the topic of volume pricing as part of our pricing strategy series. In this post, we'll take a deeper dive. Encouraging larger orders. Simply put, offering volume pricing motivates customers to purchase higher quantities so they can earn a discount. This can help move out old inventory or minimize shipping costs. Setting yourself apart from the competition. By offering a discount for larger quantity purchases, a business can create competitive differentiation, while also getting that larger order from the customer. Creating a new customer. Instead of offering volume pricing all the time, making it available for a first-time buyer can help close the deal. Then, when they are ready to make that next purchase, they have been using your product and are aware of its value. Now, you can revert to your standardized, higher price. Combating the law of diminishing marginal utility. This principle states that the more someone consumes something within a specific time frame, the less value he will place on that item. Let's say you go to a restaurant and have the twin get any better than that, right? And that first, oh so buttery bite is gastronome heaven. As you work your way through the first lobster, and then crack open the second one, that meal starts to lose its appeal. As a business, you can combat the diminished perceived value by offering volume pricing, showing a savings for buying more. Freeing up sales rep time. Salespeople are responsible for both the new customer and the recurring customer. Reorders take time for a sales rep when she could be utilizing that time to make new sales. For those established customers, you can give them a volume discount to encourage them to purchase more than they had originally planned. Volume pricing, also known as quantity pricing or bulk pricing, is a pricing strategy used by businesses to offer discounts or special pricing to customers who purchase larger quantities of a product or service. The purpose of volume pricing is to incentivize customers to buy more by providing cost savings as they increase their order size. Volume pricing can be implemented in various ways, depending on the business and its products or services. Here are some common approaches. Quantity-based discounts. The business sets different price tiers based on the quantity purchased. As the customer increases the quantity ordered, the per unit price decreases. For example, a product may have a regular price of $10, but if the customer purchases 10 or more units, the price is reduced to $8 per unit. Tiered pricing. Similar to quantity-based discounts, tiered pricing involves multiple price levels based on predefined thresholds. The customer receives a lower price per unit when reaching a specific volume threshold. For instance, the price per unit might decrease after reaching 100, 500, or 1,000 units purchased. Bulk discounts. Instead of tiered pricing, businesses may offer a specific discount percentage for purchases above a certain volume. For example, a business might offer a 10% discount for orders over $1,000. Membership or loyalty programs. Some businesses offer volume pricing as a benefit of joining a membership or loyalty program. Members receive exclusive discounts or lower prices based on their loyalty status or membership tier. Negotiated pricing. In certain B2B, business-to-business, transactions, volume pricing is negotiated directly between the buyer and the seller. The price is determined based on the specific needs, order quantities, and terms of the agreement. Volume pricing can benefit both businesses and customers. For businesses, it can help increase sales volume, attract larger orders, and improve customer loyalty. Customers, on the other hand, can enjoy cost savings, better value for their money, and increased purchasing power when buying in larger quantities. It's important to note that volume pricing strategies may vary across industries and businesses. The specific approach chosen depends on factors such as the product or service being sold, the target market, competition, and the overall business objectives. A price by volume (PBV) chart is a horizontal histogram plotted on a securities chart, showing the volume of shares traded at a specific price level. Oftentimes, price by volume histograms are found on the y-axis and are used by technical traders to predict areas of support and resistance. Price by volume charts are used to illustrate high buying and selling interest at specific price levels. They are indicative of price levels over a certain period of time. They are generally used in conjunction with other forms of technical analysis. They are also known as volume by price charts. Price by volume charts are used to illustrate high buying and selling interest at specific price levels, which can be indicative of support and resistance in a given security. It's common to see the price of a security face little resistance when traveling between levels that have small PBV bars, but the price may experience difficulty moving above or below areas with large PBV bars. Some price by volume charts also delineate the difference between buying and selling volume by shading sections green or red. These insights can be especially useful for characterizing price points as either heavy resistance or heavy support levels rather than generic levels. It's important to note that price by volume charts show total volume at certain price levels over a period of time. This means the projected support and resistance levels in the future might be outdated. For example, if a stock experienced a bad quarter and a severe sell-off ensued, there may have been a very high level of volume on one day, but that may not be entirely relevant as a support level moving forward. At the same time, The support and resistance levels are more important looking forward than looking into the past, since it has been summed over the entire time frame. Oftentimes, price by volume charts are used in conjunction with other forms of technical analysis to maximize the odds of success, including both chart patterns and technical indicators. For example, a trader may use trend lines to confirm the presence of support or resistance instead of exclusively relying on volume bars to show these pivot points. Volume pricing, also known as quantity pricing or bulk pricing, is a pricing strategy used by businesses to offer discounts or special pricing to customers who purchase a large quantity or volume of a product or service. The concept behind volume pricing is to incentivize customers to buy in larger quantities, which benefits both the customer and the business. Discounts. Volume pricing typically involves offering discounts based on the quantity of items purchased. The more units or volume a customer buys, the lower the per unit cost or the overall price. Customer incentives. Volume pricing provides an incentive for customers to buy more of a product or service by offering them a better deal compared to buying in smaller quantities or at the regular price. This can encourage customer loyalty and repeat business. Business benefits. Implementing volume pricing allows businesses to increase sales volumes and move inventory more quickly. It can also help in reducing costs associated with production, storage, and distribution by optimizing economies of scale. Tiered pricing. Businesses often set up tiered pricing structures, where the discount level increases as the volume of purchase increases. For example, a business may offer a 10% discount for purchasing 10 to 20 units, a 15% discount for 21 to 50 units, and a 20% discount for 51 or more units. Negotiation. In some cases, businesses may negotiate volume pricing directly with customers, especially in B2B, business-to-business, relationships. This allows for custom pricing agreements based on the specific needs and volumes required by the customer. Market segmentation. Volume pricing can also be used to target different customer segments. For example, businesses may offer a lower per unit price to wholesale customers while maintaining a higher per unit price for retail customers. It's important to note that volume pricing strategies can vary depending on the industry, product or service type, and target market. Each business determines its own volume pricing structure based on factors such as production costs, profit margins, competition, and customer demand. Volume discount refers to the usage of discounted prices to incentivize an individual or a business to purchase a particular good in a large quantity at one go. When a customer purchases a product in multiple units or a large enough quantity at once, the seller rewards the buyer by selling at a reduced price for each group of goods purchased. Volume discounts, most commonly used in wholesale markets, are beneficial to both parties to a sale of goods agreement. They enable a business to purchase additional stock and maintain inventory at a lower cost, and they allow manufacturers to reduce the cost of holding inventory by selling off a larger quantity of units to bulk buyers. A volume discount is different from a quantity discount, although both are fairly similar. Quantity discounts don't necessarily include purchases of a large number of units of a good. For example, at the retail level, a buy one get one free deal offered to consumers is a quantity discount. Volume pricing refers to a pricing strategy where the price of a product or service is determined based on the quantity or volume purchased. The idea behind volume pricing is to offer discounts or special pricing incentives to customers who buy larger quantities of a product. Volume pricing is commonly used in business-to-business, B2B, transactions, where companies purchase goods or services in bulk. It can also be applied in business-to-consumer, B2C, scenarios, especially for products that are frequently purchased in large quantities, such as office supplies or consumer goods. The purpose of volume pricing is to encourage customers to buy more and increase the overall sales volume. By offering discounts or lower prices for larger quantities, businesses can attract customers who are willing to purchase in bulk. This approach benefits both the customer, who receives a better deal, and the seller, who can generate higher sales and potentially reduce per unit costs through economies of scale. Volume pricing can be implemented in different ways. Here are a few common approaches. Tiered pricing. This involves setting different price levels based on specific quantity thresholds. For example, a product might have different price points for purchases of 1 to 10 units, 11 to 50 units, and 51 plus units. As the customer buys more, the price per unit decreases. Quantity discounts. With this approach, a fixed percentage discount is applied to the entire order based on the quantity purchased. For instance, a 10% discount might be offered for orders of 100 units or more. Cumulative discounts: in this case, the discount is not based order but accumulates over multiple orders. The more a customer buys over time, the higher the discount they receive. Negotiated pricing: for larger B2B transactions, businesses may negotiate customized pricing based on the volume of their purchases. This allows for more flexibility and tailored pricing arrangements. It's important to note that volume pricing strategies can vary depending on the industry, product type, market conditions, and business goals. Each company determines its own volume pricing structure based on factors such as costs, profit margins, competition, and customer demand. Volume discount refers to the usage of discounted prices to incentivize an individual or a business to purchase a particular good in a large quantity at one go. The discounts can be structured in several ways, such as setting different tiers, setting a threshold, or setting separate rates for packages. Volume discounts also exist in financial markets. Tiering, or setting different tiers. The most common technique of volume discounting is known as tiering. It means that a specific percentage of discount may be offered for a given number of units falling under that tier. The percentage of discount applicable to each tier goes up as the number of units purchased increases. For example, for a bulk purchase of product X, a 5% discount is applied to the tier of 50 to 100 units. As the tier changes to 101 to 150 units sold, a larger discount is applied, say 10%. Setting a threshold: in this second method of offering a volume discount, a lower price rate, or a higher discount rate, is only applied once a predetermined threshold is reached. For example, a volume discount may not be applicable until at least 500 units of a product are purchased. It means that the reduced price rate will only be applicable to the 500 first product purchased. The buyer will still be required to pay the undiscounted price for the first 500 units. Setting unique rates for packages of units. Under the last method of structuring volume discounts, reduced prices are offered on packages of units. For example, for good X, a discount rate of 5% may be applied to every package of 10 units, and a 10% discount may be applicable to purchasers of every 25 units. Thus, in order to reap the maximum benefits of the discount, the buyer would need to buy in batches of 25 rather than batches of 10. If the buyer buys 30 units of X, the discounted price would only be applicable for 25 units of X. Thus, the buyer would still need to pay full price for the remaining 5 units. Volume pricing refers to a pricing strategy where the price of a product or service is based on the quantity or volume purchased. It is commonly used by businesses to incentivize customers to buy larger quantities of a product, typically resulting in a lower per unit price. The concept behind volume pricing is that as customers purchase larger quantities, the cost per unit decreases, allowing the business to offer a discounted price. This strategy benefits both the business and the customer. Businesses can generate higher sales volumes and achieve economies of scale, while customers can enjoy lower prices when buying in bulk. Volume pricing is prevalent in various industries, including manufacturing, wholesale, retail, and services. For example, a manufacturer might offer tiered pricing for its products, where the price per unit decreases as the customer purchases higher quantities. Similarly, a software company might offer different pricing plans for its services, with lower per-user costs for larger teams or organizations. Quantity discounts: these are discounts applied to the price of a product based on the total quantity purchased. For example, a retailer might offer a 10% discount when buying 10 or more units of a particular item. Tiered pricing: this approach involves setting different price levels based on predefined quantity ranges. Each range offers a different per-unit price. For instance, a supplier might have tiered pricing with 3 levels: 1 to 10 units at $10 each, 11 to 50 units at $8 each, and 51 plus units at $6 each. Bundled pricing: this strategy involves combining multiple products or services into a package and offering a discounted price compared to purchasing each item separately. The discount incentivizes customers to buy the bundle. For example, a telecommunications company may offer a bundle of TV, internet, and phone services at a lower combined price than if customers purchase them individually. Minimum order quantity (MOQ). In this case, a supplier sets a minimum quantity that a customer must purchase to qualify for a reduced price. This encourages customers to buy in larger quantities to benefit from the lower price. It's important to note that specific volume pricing strategies may vary across industries and businesses. The exact pricing structure and discount levels depend on factors such as market dynamics, product margins, competition, and customer preferences. Volume discounts enable a buyer to purchase a large quantity of a good at a discounted rate. The savings made are usually passed on to the final consumer of the buyer. For example, companies, such as Walmart and Amazon, are routinely beneficiaries of volume discounts from their vendors because they always purchase a large quantity of every good. Traditional brick-and-mortar stores, or local stores, cannot make such large purchases. Walmart's and Amazon's final consumers are consequently able to make purchases at a lower amount than would be charged by a local store. In addition to retail markets, volume discounts also exist in financial markets. Brokerage firms may offer volume discounts on the commissions charged on trading. The discount may be subject to the level of investment made by the investor or the trading activity of the client. Volume pricing is a common practice between vendors and retailers in a variety of industries. For example, a smartphone manufacturer might offer a per-unit price of $400 but offer a discount of $2,500 off the total order per 50 units ordered. If a retailer purchases 100 units, the cost of the overall purchase becomes $35,000, or a 12.5% reduction in price per unit. Retailers also offer volume discounts to their customers. For example, many fast food restaurants offer upgrades in drink sizes for a fraction of the price of the base size. Tiers. In a tiered structure, order volumes fall under tiers, or groups, with each tier associated with a specific discount percentage. The higher the tier of a customer's order, the larger the discount applied. This structure is popular with retailers because it gives customers lots of purchase options. The following is an example of a tiered structure. Tier 1. For purchasing between 100 and 150 units, the customer receives a 5% discount on the overall order. Tier 2. By increasing the order to purchase between 151 and 250 units, the customer gets a 10% discount on the overall order. Tier 3. If the company enlarges the order by purchasing between 251 and 350 units, the discount rises to 12.5% on the overall order. Tier 4. Finally, by ordering over 350 units, the customer can get a 15% discount on the overall order. Thresholds. In a threshold structure, the discount applies after the customer purchases a baseline volume of goods. An example of a threshold might be 100 units. In this case, the supplier offers units 1 to 100 at the regular price but applies a discount on everything above that. If a customer buys 200 units, they pay full price for the first 100 units and a discounted price for the next 100. If the regular price is $50 per unit and the discount is 10%, the customer pays $5,000 for the first 100 units and $4,500 for the discounted items. Packages. Packages refer to increments of order volume, with a supplier offering its goods in specific batches. For example, a manufacturer might offer a pricing structure for products in batches of 10, 25 and 50. Each batch has an associated discount rate, with larger batches having a greater discount. Therefore, if a customer purchases 55 units, the specified discount might apply only to the first 50 units, with the remaining units at the regular price. This structure resembles tiered pricing, except that the discount doesn't always apply to every item in the order. Increased average order size. Volume pricing can encourage customers to buy more products per order. The appeal of discounts encourages them to increase their order volume so that they can pay less per unit. This benefit particularly appeals to customers who expect to need your goods on a consistent and regular basis, such as manufacturers purchasing parts to assemble their own goods. By boosting the average order volume for each customer, a business can increase revenue without searching for new leads. New customers. Volume pricing can also attract new customers by providing them a reason to try a company's goods or services for the first time. Some companies implement a special volume pricing category just for first-time buyers. For customers who are unsure about choosing a business as a supplier, the appeal of lower costs for them can be the deciding factor. Broader appeal. Some customers don't need or can't afford several hundred units per order, whereas others may regularly need very large volumes of products to meet their manufacturing and sales goals. Volume pricing lets businesses serve every customer by creating price points that appeal to customers with different needs. Certain structures, like tiered or package pricing, allows buyers to customize their orders while still benefiting from the price reduction. Volume pricing refers to a pricing strategy in which the price of a product or service is determined based on the quantity purchased. It is commonly used by businesses to incentivize customers to buy larger quantities of a product by offering discounted prices. The concept behind volume pricing is that as customers buy more of a product, decreases, allowing the business to pass on some of those cost savings to the customer in the form of lower prices. This strategy encourages customers to buy in larger quantities, which can help businesses increase their sales volume and overall revenue. Volume pricing is often used in B2B, business-to-business, transactions, where businesses purchase goods or services from suppliers. In these cases, the larger the order placed by the business, the lower the unit cost of the product. This approach recognizes that B2B customers typically buy in larger volumes, and by offering volume discounts, suppliers can attract and retain these customers. For example, a supplier may offer tiered pricing based on the quantity ordered. The price per unit may decrease as the customer orders more units. This incentivizes the customer to increase their order size to take advantage of the lower price, ultimately benefiting both the customer and the supplier. Volume pricing can also be used in B2C, business-to-consumer, settings, particularly for products that are frequently purchased in larger quantities, such as household goods or office supplies. Retailers may offer discounts or special pricing for customers who buy larger quantities of these items, encouraging them to stock up and potentially increase their overall spend. Overall, volume pricing is a strategy that aims to stimulate larger purchases by offering discounts or lower prices based on the quantity of goods or services purchased. It can be an effective way for businesses to increase sales and build customer loyalty, particularly in situations where customers have the capacity or need to buy in larger volumes. While volume pricing can have many benefits for companies, this practice can also bring potential disadvantages. Here are some challenges businesses might experience when implementing a volume pricing structure. Potential confusion. When companies have complex volume pricing systems, customers may find it difficult to understand what they might pay for the products they need. To overcome this challenge, a company's sales or marketing team might produce content to explain the pricing system for potential and current customers. Reduced valuation. Customers who become used to getting a volume discount might not understand the true value of the product they're purchasing, so they may resist paying full price for products that don't qualify for a discount. Effective communication between sales representatives and customers can help a company avoid this problem. Possible profit loss. If a product's discount is too steep, the price customers pay for their orders might not cover the cost of creating and marketing the products. To avoid this problem, sales managers and product creation teams can work together to set a discount that still enables the company to make a profit. Volume pricing, also known as quantity pricing or bulk pricing, refers to a pricing strategy where the price per unit of a product or service decreases as the quantity purchased or ordered increases. It is commonly used by businesses to incentivize customers to buy larger quantities of their products or services. The basic principle behind volume pricing is that by buying in larger quantities, customers can benefit from economies of scale, which allow businesses to reduce their production or operational costs and pass on the savings to customers. This can encourage customers to purchase more, resulting in increased sales and potentially higher profits for the business. Volume pricing can be implemented in various ways, depending on the business and industry. Some common approaches include tiered pricing. In this model, the price per unit decreases at predefined quantity thresholds. For example, a product may have one price for quantities below 100 units, a lower price for quantities between 100 and 500 units, and an even lower price for quantities exceeding 500 units. Volume discounts. Businesses may offer percentage-based discounts on the total purchase amount. For instance, a company may provide a 10% discount for purchases over $1,000 or a 20% discount for purchases over $5,000. Contract pricing. For business-to-business, B2B, transactions, companies often negotiate pricing agreements based on expected volume. This allows businesses to receive preferential pricing based on the volume of products or services they commit to purchasing over a specified period. Membership or loyalty programs. Some businesses offer membership programs or loyalty schemes where customers pay a fee to gain access to discounted prices or special promotions, regardless of the quantity purchased. Volume pricing can be advantageous for both businesses and customers. Businesses can benefit from increased sales volume, improved cash flow, and stronger customer relationships. Customers, on the other hand, can enjoy cost savings, better value for money, and potential perks or benefits associated with buying in larger quantities. It's worth noting that volume pricing is not suitable or feasible for all businesses or products. Factors such as production costs, market demand, competition, and target customer base need to be considered when determining whether to implement volume pricing and how to structure it effectively. Analyze data. The first step to establishing a volume pricing model is analyzing sales data and performing research on the company's competitive landscape. Examine sales figures from the past few years, focusing on profit margins and per-sale volumes. It can also be helpful to look at the pricing models of the company's direct and indirect competitors, which can help you establish a structure that differentiates the company from them. Understand the company's core customers. Understanding the company's existing customers' needs can help you determine what products might benefit from a discount and how much of a reduction to offer. For example, if most customers make small but frequent purchases, you might offer a relatively high discount on large volume orders to encourage higher quantity sales. Companies that already make bulk purchases often might not benefit from a volume pricing strategy, which might devalue the products in the customer's opinion. Decide which products to discount. Volume pricing can be effective for products that customers purchase often, but this method might not provide any sales benefits for high-priced products that customers only purchase every few years. For example, an office supply firm might offer volume pricing for pens and notepads, since customers might order hundreds or thousands of these products each year. The firm might use standard pricing for office refrigerators and coolers, since most customers don't buy them in large numbers. Review the production costs and average order volume for each product the company sells and choose a few products to use. Calculate maximum allowable discounts. Once you've decided which products you can discount, you can calculate the maximum discount you can apply to each product. Examine the company's revenue, gross profits and net profits from previous years to forecast how much you can expect to earn. Then calculate different discount percentages to see how much you can deduct while remaining profitable, allowing for the possibility that the discounts may produce more sales overall. When you determine a maximum discount for a certain product, ensure that the product's new price still covers the cost to create and market the product. Determine a pricing structure. Data such as profit margin and sales volumes, as well as your calculation for maximum allowable discounts, can help you determine which pricing structure might be ideal for each product. For example, if the company's profit margin is fairly large and the average order volume varies widely depending on the product, the sales organization might benefit from a tiered pricing structure, which offers high discounts and can incentivize purchases of ordinarily low-volume goods. Alternatively, you can apply a different structure to each product type, providing greater discounts for higher-selling items and limited discount options for others. Keep track of sales and adjust accordingly. With a volume pricing structure in place, track sales and revenue to ensure growth. If the new pricing structure results in increased volumes per order and a wider profit margin, you can consider it a success. Rather than making any adjustments to the model, you can focus your efforts on expanding the customer base to increase profits. If, however, you see no appreciable growth, reanalyze your data to see what areas need improving. For example, if the company's sales are steady but the profit margin hasn't grown, your discounts may be too high. It encourages customers to buy more. As we've already mentioned, it's hard to resist a good discount. By rewarding your customers with greater discounts for buying greater amounts, you're creating the incentive for them to purchase more. The volume pricing method works particularly well if you're looking to shift materials quickly. And it works even better when there are minimal costs involved to allow more customers to access your product, with no need to make or distribute more for new users. It ups your competitive value. Offering your product or service at a reduced rate can put you ahead of the competition. If you're offering a similar service or product to competitors, what's going to turn heads in your direction? The same value and positive impact, but at a cheaper or more reasonable price. And who doesn't love a bargain? Volume discount pricing motivates your customers to increase their demand and buy more because they see greater value in your product. Plus, growing businesses are more likely to return to you if, for example, they need more licenses, an easy upsell for you. That's why your pricing strategy is so important. It helps you stand out in a crowded marketplace. They may view your product as cheap, low quality, or totally overpriced. 3 opinions that will quickly lead your target audience into the hands of your better-priced competitors. It appeals to a wide audience. It's not only the pricing strategy that can boost your sales, it's the promotion too. By creating different price points or segments in your pricing plan, you're appealing to small businesses who may need just 5 licenses at a reasonable price, and to larger businesses who need 5,000. A volume discount solution prevents the final price of the package from becoming obscenely prohibitive for larger organizations. Plus, volume discounting grants reduced rates of products that can appeal to, and incentivize, businesses, both big and small, to opt for larger quantities. Whether they have future scaling in mind or they just can't deny a good deal and see the value of buying more, you're making the decision to buy more a whole lot more tempting, and a whole lot easier too. Volume pricing, also known as quantity pricing or bulk pricing, refers to a pricing strategy where the price of a product or service is based on the quantity or volume purchased. It is commonly used by businesses to incentivize customers to buy larger quantities, thereby increasing sales and benefiting from economies of scale. In volume pricing, as the customer purchases more units or a larger volume of products or services, the per-unit cost decreases. This encourages customers to buy in larger quantities, leading to higher sales volumes for the seller. The idea behind volume pricing is to offer discounts or special prices to customers who buy in bulk, making it more attractive and cost-effective for them to purchase larger quantities. Volume pricing can be implemented in various ways, depending on the nature of the product or service and the specific business model. Here are a few common approaches to volume pricing. Tiered pricing. This method involves setting different price levels for different quantity ranges. For example, a product may have a price of $10 per unit for quantities up to 100, but the price may decrease to $8 per unit for quantities between 101 and 500. Quantity-based discounts. With this approach, the seller offers a flat discount or percentage off the total price as the customer purchases a higher quantity. For instance, a business may offer a 10% discount on orders of 10 units or more. Membership or loyalty programs. Some businesses offer volume pricing as a benefit of membership or loyalty programs. Customers who enroll in these programs may receive special pricing based on their membership level or accumulated loyalty points. Negotiated pricing. In certain cases, especially in business-to-business (B2B) transactions, pricing may be negotiated based on the volume of the order. Buyers and sellers engage in direct negotiations to determine the price based on the anticipated volume of purchase. The specific details of volume pricing can vary across industries and businesses. It is important to carefully analyze the costs, profit margins, and market dynamics to determine the most effective volume pricing strategy for a particular product or service. Customers devaluing your product. The psychological side of discounts is all well and good. However, if the pricing plan isn't well thought out, your customers can quickly cross the line from questioning how the product or deal is so cheap, over into the deadly zone of questioning why it's so cheap. When the value of your product is being scrutinized, you could be in trouble. Lowered price value. By lowering the price of your product, you are setting a new standard for your product pricing. If you're looking into volume discounting as a growth method for your business, make sure you take this into account because a steep price increase is no customer's favorite thing. Profit loss. Of course, by offering your product at discounted rates, whichever volume pricing formula you're opting for, you're missing out on profit. Do the math to make sure that you're getting in the extra sales to make up for the price reductions you're offering up. Volume discount refers to offering discounted prices to motivate customers to purchase larger quantities of products or services. On the other hand, a quantity discount does not necessarily result in the purchase of a larger volume of products or services. Take, for example, buy one get one free. It is considered a quantity discount, though it does not necessarily result in large quantity sales. Volume discounts benefit buyers because they get an opportunity to restock their inventory at a significantly cheaper cost. In turn, it empowers them to offer their consumers lower prices on the products without incurring losses. It depends on your product or service. Volume discounting is an excellent means of driving sales, appealing to new markets, and increasing your competitiveness in the market. However, it requires strategy. It would be best to provide time-sensitive, infrequent offers to guarantee profitability and growth in the long term. Volume discounts and bulk discounts are often used interchangeably because they mean the same thing. It's a discount on a product purchase based on a specific minimum quantity or volume of products/services. Volume pricing refers to a pricing strategy in which the price of a product or service is determined based on the quantity or volume of units purchased. It is often used by businesses to incentivize customers to buy larger quantities of a product, as the price per unit decreases as the volume increases. Volume pricing can be beneficial for both buyers and sellers. For buyers, it allows them to obtain a lower price per unit when they purchase larger quantities, which can result in cost savings. For sellers, volume pricing encourages customers to buy more, leading to increased sales and potentially higher profits. The specific structure of volume pricing can vary depending on the industry, product, and business model. Here are a few common examples. Tiered pricing. In this model, different price levels are set for different volume ranges. For example, a product might be priced at $10 per unit for quantities up to 100, $8 per unit for quantities between 101 and 500, and $6 per unit for quantities above 500. Bulk discounts. With this approach, the price per unit decreases as the total order quantity increases. For instance, a product could be priced at $10 per unit for a quantity of 10, but the price could drop to $8 per unit for a quantity of 20 and further decrease to $6 per unit for a quantity of 50. Membership/subscription pricing. Some businesses offer membership or subscription plans that include volume-based pricing. Customers pay a recurring fee to access discounted prices on products or services based on their membership level or subscription tier. Negotiated pricing. In certain cases, businesses negotiate pricing with individual customers based on the volume they are willing to purchase. This approach allows for customized pricing agreements that can be tailored to meet specific customer needs. Volume pricing can be an effective strategy for businesses to incentivize customers to buy more and increase overall sales. It also promotes customer loyalty and encourages long-term relationships with buyers. For example, a software company may offer a discount for purchasing multiple licenses, or a consumer goods company may offer a discount for buying in bulk. In addition, volume pricing can also help businesses manage inventory and production costs. By producing goods or providing services in larger quantities, businesses can take advantage of economies of scale and reduce their per-unit production costs. This can help increase profit margins and competitiveness in the market. However, businesses must also be careful not to offer discounts that are too steep, as it can erode profitability and damage the brand's perceived value. Overall, volume pricing is a useful tool for businesses to increase sales and revenue while managing costs. Volume pricing is a pricing strategy where businesses offer discounts or reduced prices for larger quantities of a product or service. The goal of volume pricing is to incentivize customers to buy more and increase sales for the business. This type of pricing works well for businesses that have high production or acquisition costs. By offering discounts for larger quantities, businesses can improve their profit margins while still providing value to their customers. Volume pricing is commonly used in industries like manufacturing, wholesale, and retail. For example, a manufacturing company may offer a bulk discount to a retailer who orders a large number of their products. The retailer can then sell these products at a higher price, and both the manufacturer and retailer benefit from the increased sales volume. Volume pricing can also be used to target specific customer segments. For instance, a gym may offer discounted rates for corporate groups or seniors. This can help the gym attract more customers within these demographics, ultimately increasing revenue. One drawback of volume pricing is that it can be challenging to establish the appropriate discount levels. The discounts must be attractive enough to encourage customers to buy more, but not so steep that they harm the business's profit margins. Additionally, businesses may need to implement more complex pricing structures to account for the different quantities that customers may purchase. Overall, volume pricing can be an effective strategy for increasing sales and improving profitability in the right circumstances. By carefully considering cost structures and customer segments, Businesses can create pricing structures that provide value to customers while still generating revenue. Volume pricing refers to a pricing strategy in which the price of a product or service is determined based on the quantity or volume purchased. Businesses to offer discounts or incentives to customers who buy larger quantities. The goal of volume pricing is to encourage customers to buy more by offering them cost savings as they purchase larger quantities. This strategy benefits both the customer and the seller. Customers enjoy lower prices per unit, while sellers can increase their sales volume and potentially improve their overall revenue. Volume pricing can be implemented in various ways, depending on the nature of the product or service and the business's goals. Here are a few common approaches. Quantity-based discounts. This approach involves offering lower prices as the customer purchases more units. For example, a retailer may offer a 10% discount for purchasing 5 or more items. Tiered pricing. In this method, different price tiers are established based on volume. As the customer's order quantity increases, they move to a higher tier and receive a lower price per unit. For instance, a software subscription service may have different pricing levels based on the number of users or licenses required. Bulk pricing. This strategy involves setting specific prices for bulk or wholesale purchases. Businesses often offer significant discounts for customers who buy large quantities, such as wholesalers or resellers. Negotiated pricing. In some cases, businesses may negotiate pricing directly with customers based on their specific volume requirements. This approach allows for more flexibility and customization to meet the customer's needs. The specific terms and conditions of volume pricing can vary significantly across industries and businesses. It is important for businesses to carefully analyze their costs, profit margins, and market dynamics when implementing volume pricing strategies to ensure they remain profitable while providing attractive incentives to customers. Thank you for watching the video and subscribe the channel.